Welcome to Women and Wealth, the podcast from Investors Chronicle aiming to give you the tools to make the most of your money, even when society makes your life harder than a man's. I'm Madi Apthorpe, digital production journalist at Investors Chronicle.
And I'm Val Cipriani, personal finance editor at Investors Chronicle. In this podcast, we tackle the big money issues that disproportionately impact women. So, Madi, we're back. We're back, and we are going to be doing things slightly differently, just because there will be some episodes that are more dedicated to women's financial issues and some episodes that are going to be talking a bit more about investing in general.
Exactly, yeah. Not all of these episodes are, strictly directed to women, so people should feel free to send them to the men in their lives. They'll probably like them. But this week's episode, we are talking about the relationship between investing and psychology, known as behavioural finance. So we'll start by talking about why this matters, and then you're going to share some really interesting tips on how to avoid the mistakes that commonly come with it. And then later I'll be joined by a guest who is a senior finance lecturer at King's College Business School, and we'll talk about gender bias in investing. But first of all, what's investing got to do with psychology?
Yeah, it's interesting, isn't it? Because it's not necessarily two topics that you'd think go together. But the thing with, managing your money well, and so it can be, personal finance, it can be budgeting, it can be investing, is that you are in a bit of a battle with your emotional brain. So your emotions want you to do things that are not necessarily very good for your long-term financial well-being. And so, your rational brain has to be in the driving seat and sort of be the one that takes the decisions, and just will, like with other areas of your life, that is not super easy to achieve. And so I think with investing in particular, that is tricky because it's not quite maybe as obvious as it might be in other areas. So for example, with budgeting, like, you should batch cook and stop going to that incredible noodles place down the road every day when you are in the office.
Are you speaking from experience?
Yes.
Yeah, it is good noodle place.
Yes, it's very good. The noodles are great, but they're also like, what, £8 or something?
I know.
Like, you shouldn't do it every time you go to the office. So, that's very obvious. That's a very intuitive thing. And with investing instead, it's tricky because, it's a difficult topic. It's full of jargon. People don't necessarily know loads about it. So, it's very hard to build confidence. And in such a situation where you're not sure what you're doing in the first place, it's very hard to let your emotions take over.
Yeah, I think, like you said, emotions drive us in so many different ways. But when it comes to investing, what should we not do that our emotions may tell us to do?
So there's quite a few things, and I should say these, biases, sometimes they're called, or mistakes, they very much do impact very experienced investors as well. Like, loads of people can fall trap to them. But maybe starting from some more basic things for beginners. So when you get started, you will inevitably feel like selling your investments when the markets are down. So we've spoken about this before. Stock markets go up and down on a daily basis, and sometimes something happens and they crash and they go down a lot. And when that happens, you will be a bit tempted to sort of, seek emotional comfort, basically.
Definitely. I mean, people get very anxious. They start to worry about their futures, their savings. It makes sense that you would want to do that.
Yeah, and so the risk there is obviously, selling and reverting into cash. Now, we have said before, why this is bad, because if you revert into cash, then, those losses are crystallized, as the technical term is. And so, at that point, you've actually lost money, and you can very easily miss when the recovery is going to happen. And so your investments are going to go up again. And it's quite interesting because most investors, this is quite a basic principle, and people know about this. So they know that they should stay put and wait. But the problem is that often, market crashes, they don't necessarily last a day. There can be something called a bear market, which basically means when the market goes down by more than 20%. It can take some time. It can take weeks. It can take months. Very occasionally, it can take, years potentially. And so while that time passes, for all the time you spend waiting and, being like, oh, no, I should wait. I should not revert to cash. I should leave my money invested. Your confidence is being eroded. and so it becomes harder and harder to stay still and stay composed. And you are more likely basically to persuade yourself that, this time is different, and maybe this time the stock market is not going to recover. So actually you should just, cut your losses and flee. And it's quite funny, like an investment manager once was telling me this thing that basically, when she said when she started getting loads and loads of calls from clients who wanted to take their money out, she was like, well, that's probably when a recovery is about to happen. It's just kind of interesting because it's the way our brain works. Because if you think about it, the more time has passed since the crash or the bear market has begun, the closer we are to the recovery, like in time terms. But equally at the same time, because of because of the way our brain works, we are more likely to want to take the money out.
Yeah, that makes sense. So, I mean, just to kind of sum it up, you want to remember that you've got this long time horizon, stick it out. And I guess I also have a question about, so, we've covered what happens to your emotions when markets go down, but what happens with your emotions when markets are on the up?
Yeah, it's a very good question. So first of all, the crucial thing is that you don't know when they're going to go back up again. So the first stage of this is just like, from a sort of practical, technical perspective, timing a recovery is practically impossible. So that's also why you should keep staying invested, because you can't just guess when the markets are going to go up
Right.
again. So that's problem number one. Problem number two is that, once you've taken your money out and you've been burnt, it's emotionally very difficult to go back in again. And then you have the other issue, which is what you invest in, which I think becomes very important when markets are going up. So when markets are going up, generally, you will see your confidence going up, and you might get a bit excited, even maybe a bit overexcited. And I think when that can potentially become a danger is when you pick investments based on, what happened in the past. So I'm going to explain this better. When you start investing, you will often see a disclaimer that says past performance is no guarantee of future returns. And then if you do a bit more research, you might hear someone say that markets are forward-looking. Now, this is all well and good, but what does it mean? It
Right.
means in practice that, the stock market only cares so much about what's happened to a certain company in the past. What it tries to do instead is look at potential risks and things that might potentially happen in the future and impact the performance of that company in the future. So they're looking ahead. However, as human beings, we're not necessarily very good at trying to look at the future. What we might instead do is, see that a company, for example, has done really, really well so far, and we're not invested in that company, and get, fear of missing out and be like, oh, I need to take part in this because it's growing so fast, and I need to get into this.
I think that really reminds me of meme stocks and, the kind of craze that happens around those, and then so many people lose
Yeah,
vast amounts of money.
yeah, it's a good example. It's quite an extreme example, but it's a very good example. Basically, you can end up, because there's hype around something, you can quite easily end up buying something that is really expensive, and then even this is different situation that with meme stocks, but even if it's a company that is a good business, if it's become really expensive, it's not necessarily going to be a good investment. Here we maybe go back to something we discussed quite early on, which is that when you get started with investing, it's usually better to start with funds rather than by picking single stocks, because that kind of protects you a bit against this sort of feeling of wanting to chase the companies that are doing really well, chasing the hype, which is not to say that that cannot happen with funds, that cannot happen to fund managers. It can most definitely happen, but with a fund you just get more diversification and you're not making the choices yourself, so you're kind of spreading your bets a bit.
Okay, and we've spoken quite a lot about funds, and you've got active funds and passive funds, but active and passive, I don't know if we've ever properly defined. Could you go into that a little bit, please?
Yeah, absolutely. So it's very relevant to this. So the difference between passive and active investing is all about something that is called an index. So an index is just a list of companies at its most basic. So includes all the companies on the stock market that fit certain criteria. And those criteria can often be very basic. So, for example, the MSCI World lists all the major companies in all global developed markets. So that is basically the US, the UK, Europe, and Japan. So all the companies are in there, ordered according to their size. Or, for example, you got the FTSE 100, which is just the 100 biggest companies in the UK. So when you're investing passively, so for example, buying a passive fund, you are just investing according to what the index says. So for example, the biggest company in this index might be worth 5% of the index. You're going to put 5% of your money in this biggest company. Then the second one might be 4%. So you put 4% in this other second company. And you just mirror whatever stock market you've chosen to invest in. So that means that your investments are going to perform in line with that market. And you're not trying to guess, if there is one company that is going to do better than one other. You're just investing in the market as a whole. So that is one option.
Okay.
The other option is active investing instead. So active investing is then when you are picking companies that you think are going to perform better than the index, better than the market as a whole. And so you're going to put more money into those companies and kind of make a bet on them. You can do it yourself, so pick stocks yourself, or you can just put your money into what is called an active fund, where there is a fund manager that picks the companies for you.
Okay.
And so this is all to say that with active investing, it's a bit easier, isn't it, to kind of be swept away by hype and FOMO and all that.
Yeah, 100%. I mean, going back to emotions like we were talking about earlier, it seems that you have to be really, really mindful of keeping your emotions in check when you're choosing to stock pick or to go with an active fund. Well, I guess it's the fund manager's emotions really then that you're playing with in that respect, isn't it?
It is, but I think there is a little bit of an element for you as well. There are hundreds of different funds. They do different things, but they have sometimes different styles. So there's a lot to research around that. But sometimes you can have that same sort of FOMO or hype for a fund if it's done especially well. And then, if you're a bit unlucky, that's when the fund manager starts making the wrong choices, or the style, the way the fund manager invests in goes a bit out of fashion, and then it starts underperforming. So to an extent, there is that with funds. And I should say, actually, it can in a way also happen with passive investing, in the sense that, bubbles are not exclusive to active investing. They're not at all.
And with something as, undeniably universal as emotion, there must be a lot of research about how emotions come into play when it comes to investing. Could we touch on some of those?
Yeah, absolutely. So I think I was saying at the beginning that, even expert investors fall prey to these things, and they're usually called biases. And what biases are, it's about the way your brain already works in general. But when you apply it to investing, it makes you do certain things that are not necessarily the best practice for, obtaining the best long-term returns. And so it's kind of useful to be aware that your brain does these things, because then you can make a conscious effort to counteract it a bit. So some examples of biases are familiarity bias. So we like things that we know. Okay, that's a fairly basic principle. And so that means that you might want to invest in companies that have brands you're familiar with. I think Apple is a classic example, because we all know it. Many of us use its products. So we might want it as an investment, which, in the case of Apple, can easily be a good investment. It's done really well, obviously, over the past few years, but it shouldn't be the rationale. And on that note, you also have a thing called home bias, which is basically just the fact that when constructing a portfolio, investors have a tendency to invest a bit more in their own country's stock market. So, for example, the UK market, I think now is roughly 3% of global markets, give or take. But if you live in the UK and you know its companies, you might be tempted to put a bit more. Which, it's not always a bad thing. But again, something to be aware of, because obviously you don't want to put too much there, and then it would mean, for example, that you don't have enough in the US or enough in other countries that may be doing very well, for example.
Right. So with the familiarity bias and the home bias, it does sound like you're in a bit of a battle with your emotional brain quite a lot when it comes to investing. But what does losing that battle kind of look like?
Oh, right. Okay. Well, in the worst case scenario, it looks like losing quite a lot of money,
Okay.
because if you crystallize your losses, you sell when the markets are down, and then you don't go in, or you go in at like when it's too late and you miss out on the recovery. Or we talked before about hype. If you go and invest into a company that's been really, really blown up, and then it crashes, then the money is just lost. So that's the worst case scenario. But other than that, so there's a firm that researches behavioral finance. It's called Oxford Risk. I actually did a course with them earlier this year that was really, really useful. So some of the things I'm talking about, I've learned from that. That estimates that something called the behavioral gap exists. So the behavior gap is just about the difference between the returns you can obtain in theory if you invest perfectly in the way you're meant to do, respecting all the theories and the rules and all that, and the returns that a person like you and me actually obtains if we give a go at investing, and presumably we're going to make mistakes. And so they estimate that the behavior gap is about 3% a year. So 3% is quite a lot in investing terms, right? Because it's very hard to say, how much is a portfolio going to make a year. It's very difficult to say. But for example, I think in the year to August 2025, global stock markets had a really, really good year. Keep in mind, this was a very good year, and they were up about 16%. Now, 3%, if you take it out of that, is significant. And also in monetary terms, it means, say you've got £10,000 invested, and maybe, you don't have a super high risk portfolio, you make 6% in a year, decent returns. So at the end of the year, you've made 10,000, you've got 10,600. But if you cut 3%, like instead of 6%, then you've got 10,300. So, over time that compounds. So it's quite a big impact.
Yeah, you'd really want to avoid getting into a situation where that is the outcome. How can we avoid having our emotions take the better of us then?
So I should say of that 3%, a chunk of it is just about people not investing enough or keeping too much money in cash. So, if you've got this idea to start investing, that's already one big step that you're taking to kind of tackle that. But other than that, I think a very important principle is the fact that, emotions are going to be there. They're going to happen. So it's kind of useless to ignore them or be like, oh, no, I'm not going to have them. So what you need to do is like plan around them. So build the system that prevents you from making those mistakes when you're having those emotions. And there are a few ways to do this. You can start by, thinking about how you want to approach investing when you're calm. Like, at a time where markets are not doing very much. And, you want to make a plan and you want to write down the plan somewhere. And then you want to be like, right, I'm not going to make any change to my portfolio before checking the plan. And then I'll be asking myself, does this match with the plan or does it not match with the plan? If it doesn't, you're not going to make those changes. And on a similar note, another thing you can do is establish what they are commonly called pause points. So a pause point just means I am gonna have a think before acting. Sometimes I use it with shopping. Like if I want to buy something and I'm like, ooh, I really like that thing, but I'm not sure whether, it's gonna look good on me, whether it's gonna look good in my house, whether I actually need it. I'll be like, right, I'm not gonna buy it for like 24 hours or 48 hours. And then I'll see where my brain is at tomorrow or the day after tomorrow. It's a very sensible way of doing things. And you can apply it to investing. You can just, at the beginning when I said, you make a plan, right? As part of your plan, you can be like, I'm not going to act on an investment decision for 48 hours. And that gives you, it gives you time to like take break, sort of think. And then another interesting thing is that there is something called confirmation bias. So confirmation bias is once again about how our brains work in general. So what we do is that if we have an opinion, we are gonna try and look for information that confirms that opinion, and we are gonna be trying to overlook any facts that go against that opinion. So we reinforce our own biases and our own opinions, and that happens with investing as well, and can be quite dangerous because you are only gonna look for things that tell you that you're right.
Yeah.
So to sort of counteract that, if you have a post point, you're like, okay, I've got 48 hours. In those 48 hours, I'm going to spend a bit of time researching the counter argument and see what I find, and try and keep an open mind to the counter argument and see if I'm still convinced that I need to make that decision. And maybe you do, but maybe you don't.
Maybe you do need to buy that rug.
Yeah, maybe the rug is great. Maybe the shirt looks fantastic and I should buy it. But it's better to have a think first. And then the final thing, which again is something we've mentioned before, is around automating investing. So I think we've spoken maybe in the first episode about regular investing, which is quite good. You just invest a set amount every month, maybe on the first of the month, through a direct debit. And that kind of thing is really good because, if you set up the direct debit and also set it up in a way that the platform is going to do the investing for you and you don't need to touch it, then, what the markets are doing doesn't really matter, and your emotions are not going to be able to sort of interrupt that process. So yeah, it can be quite an helpful thing to do.
Okay, so have a pause point, don't make any rash decisions, and automate your investments. That sounds pretty doable. So I'm happy to be joined by Dr Ylva Baeckström, a senior lecturer in finance at King's Business School, who has a research background in the intersection of gender, psychology, and financial decision-making. Welcome to the show.
Thank you, Madi.
So let's begin with what you see as maybe some of the biggest psychological barriers that tend to stop women from investing.
So I think what we have to make clear first is that psychological barriers are here for a reason, and that is legal exclusion. So women were excluded from participating fully in finance and investing for many years. It wasn't until the mid-1970s that women could become members of the London Stock Exchange or open bank account in their own names. And therefore, financial investing is a newer domain to women than men. Coupled with that, women are paid less for working in financial services and working anywhere, quite frankly. And then we have societal gender stereotyping and bias against women as investors, women as professionals. And media tends to portray successful investors as white men. But you're obviously doing great by having me here today talking about finance and investing. So thank you for that. But all of those things are real barriers, structural barriers that of course then create psychological barriers.
Yeah, I completely agree. And like you said, it is a creation from the cultural barriers. And in the past, you said modern finance was created by men for men. So from what you've learned in your time in both academia and your career in finance, what are some patterns, I guess, that you've seen in how women approach decision-making and risk different to men?
So again, I want to be really clear that the reasons there are differences is not because there are innate differences in women when they are born, that they are less risk tolerant than men or less confident. But yes, structural barriers have created differences between men and women. And what we see is men as more confident and more risk-prone investors. Men also believe more in their abilities to invest. So they have, we can call it higher financial self-efficacy, a belief in their own abilities. But that's not necessarily a good thing, because it makes overconfident investing can harm your performance. So my research and other research shows that women, when they do invest, their investments perform better than the investments that men hold. However, the real risk that women face is not investing. Women live longer than men, they earn less during their lifetime, and they need to invest in order to secure their financial future. So that's a real risk, and we need to encourage women to invest. And I think we can do that by opening up the conversation, by making it okay to talk about money and investing.
Like you said, there is an attitude that women are less confident, but that's not true. And how do you reckon we could bring to light the truth behind that and air to the world that women are actually competent and good investors?
We need to showcase that women are competent and good investors. Media has to portray women as the confident and competent people they are. We need to see more opinions from women leaders, from women's finance leaders in particular, and women investors. If we Google a successful investor, we get a lot of pictures of white men looking a little bit like some financial movies that we all will have seen. So the issue is that we don't celebrate the greatness of the women investors who are out there.
I think I'm right in saying that your PhD focus was on bias and gender differences when it comes to investing. Could you kind of elaborate on that a little bit, please?
My research focuses on financial advice and on gender differences in financial decision making. And then, of course, with that comes stereotyping and bias in the financial advice process and towards women in general. Now, I do find that when you look at the population as a whole, there are those differences that women feel that they have less financial knowledge, they feel they are less risk tolerant, and they make sort of more conservative portfolio investment decisions, and they are then less confident than men. However, that's in the population as a whole. If you then separate that and look at successful women as successful in terms of careers or wealthy women, they are just as confident as male investors. And they take as much risk quite often if they pair with a female instead of a male financial advisors. So because finance was sort of built by alpha men for alpha men in the beginnings, then it doesn't really cater for a diverse audience or the target market that it wants to reach or that needs to be reached. So the way that you treat a woman when it comes to financial matters really makes a difference.
And I guess relating to what you said about the world being built by men for men, if you could redesign the financial world with women in mind, what would you leave out and what would you include?
I speak exactly about this in my book, about how you would redesign financial services. But you can't design a system that should reach the general public by a homogeneous bunch of people. You need to get together a diverse team that represent as many groups in society as you possibly can to design something that works for everybody. We won't feel accessible to people. And that's part of the issue, is that the jargon, the culture, it just feels daunting, it feels intimidating, and people would rather stay clear of it than to try to access it.
And what can we do to promote financial education?
I'm just about to start a research project on financial education. So next time we meet, I can talk to you more about it. But financial education clearly doesn't work for women or men in its current form, with so many children leaving school without knowing enough about managing their personal finances. But has anyone asked young people how they want to learn about finance, how to make it fun? Having the conversation about investing is always right. Make it cool to speak to your friends about investing. Speak about it in your family. Ask people about it. We need to make it an okay subject to talk about, just like we talk about anything else. And like that, we can learn from each other, we can share our knowledge, and we can inspire others to become investors.
What is one mindset shift that someone of any gender, of any age, listening today could make to make the world of finance and investing a little bit less intimidating? Or maybe something that you would have said to a young you?
Knowing that you're not alone is really important. The vast majority of people are anxious about managing their financial affairs, so you are really not alone. The key to feeling better about it and managing your own anxiety is to learn about it. And remember that finance and investing is much less complicated than it sounds. The jargon, I think seriously, those of us working in the city, we made up all that jargon just to keep our jobs. It's really not that complicated when it comes down to it. So just learn about it.
Okay, well, thank you so much. It's been really, really insightful.
Thank you.
As always, if you enjoyed this episode of Women and Wealth, follow Investors Chronicle on whatever platform you get your podcasts on, and head over to our website to get access to all of our stocks and shares news and analysis.
And if you have a question or a topic you'd like us to unpick, please send us an email at womenandwealth@ft.com. Thank you for listening.